Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Hey everybody, I want to welcome you to what I guess is now our monthly stock market therapy session. Okay, so the market was down today. It was really bad. In fact, it was the worst month. Today we're down 900 points, but it was the worst month since March of 2020. If you were investing back then, you know it was not fun. It was not fair. Nobody really liked it. When they were going through it, nobody really liked it. But also for tech companies, it was even worse. It was the worst month for tech stocks since 2008. That was not a good year in case you weren't around to invest through that. So today I'm going to give you some things you need to consider and some encouragement in this time of difficulty. Okay, so the first thing here is, remember when I said last week, it was probably last Friday honestly, where I said that some of the best days or some of the worst days in the market are almost, followed up by some of the best days in the market, usually within a few days. Well, yesterday was a great day. Yesterday, the market was up like 600 or 700 points. It was because Apple announced earnings. Apple was doing fine. The market said, great, Apple's doing well. We all doing well. And today, the market did the opposite and said, oh, Amazon's not doing well. We are all not doing well. And this is something that we did talk about. So number one, this is proof and evidence, if you haven't noticed it already, that we as investors and just as humans focus on the negative more than we do on the positive. Instead of everyone saying, hey, look, today was bad, but yesterday was great. I'm going to focus on what happened yesterday and why and what worked. Everybody's focused on how bad today was and how bad the entire month was. Both are factual, right? But where your focus goes, you're going to look at that more. You're going to get more of that, right? So that's number one. The other thing too is we kind of expected this. We did talk about this. I did a video on Monday and a TikTok and an Instagram and even an email all this week talking about how important, how crucial this week was going to be. Now, if you're on that email list, which shows up in every video, you got that email. You got further warning, if you will, or preparedness or awareness is probably the best word here, that we knew that Microsoft and Apple and Amazon were all going to report at the same time during the same week. And that I told you then that about 20% of the entire stock market is concentrated in just those 4 or 5 stocks. That's it. So where they go, the market follows. And today we found out. Today, Amazon was down almost 14% and dragged the entire stock market down because of it. But if you knew this Monday, you might have been like, all right, hey, I'm just going to relax. I'm going to go do whatever it is it's going to do because I know that tech stocks aren't great this year. We knew that, right? And every company I just named were all tech stocks for the most part. So it would make sense. Like honestly, the thing that was most shocking was the fact that Apple made money and they were doing well. That was shocking because I expected it not to go well. But that's earnings season for you. We've talked about this every quarter about how crazy earnings can be, how companies can do well. Like Nvidia, I complained about that one, where a company does well, best quarter in 10 years, I keep saying it, and then the stock still tanks. That's 2022 for you, okay? So as an investor, this is a time to learn, and it's a time to learn a few things. Number one, if you have not done it already, if you have not watched the defensive videos already, you have the choice to adjust your portfolio and pivot. You can now, depending on what you invest in, you can sell out of some things that aren't working now and buy things that are more defensive. Go back and check those videos, healthcare, real estate, grocery stores, all that kind of stuff. You can do that. Or you can say, look, I don't like how Netflix is performing. I don't like how Amazon is performing. I am going to hold on here because I believe in them in the long term. That's if you do. I'm just giving these as an example. And I'm going to add, instead of subtracting or switching, I'm going to add other companies to kind of balance things out and improve or at least reduce the blow of what's going on in 2022 so far. Okay, so those are some of the things that you can do, and we've gotten videos to really coach you and guide you through a lot of that. But the thing that I really want to focus on, and I really want you to focus on, is this: Everyone here would say that if someone gave them $1,000 or $10,000 in 1998, that you would buy something like an Amazon and you would hold it for forever, and in 2022 you'd be a multi-millionaire. Everybody says that. Everybody wishes, myself included, that when I was born that I could have put $100 a month in an Apple and I would be sitting on $2 or $3 million today. Everybody says that. But to get there, you have to go through times like this. Okay, so to get to that $1 million mark, sometimes it's, hey, I'm going to continuously invest, or I'm just going to hold what I have, and it's going to be, a year, 2 years, 3 years, 4 years, or more for me to really see those gains. And the reason why I want to bring that up is because I have a chart of Amazon. I also have one of Netflix. Now I'll put these up here too, is that, and again, this is not an endorsement to buy Netflix, but in 2000, the stock was down 79%. 2001, it was down another 30%. If you sold, you would not be a multimillionaire today because you would have sold it in 2001, right? So you would have lost 79%, turned around, lost another 30%. In 2005, lost 15%. And I'm skipping around here. In 2008, lost 44%. In 2014, you would have lost 22%. Those are significant losses, and right now, as of today, Amazon is down 25%. Now, that's not a guarantee that next year and the year after are going to be great, because the market is different in 2022 than what it was in 2008, than what it was in the 1990s. But it's just an example to show you that to get to what you think you want, everybody says that I would think I want to invest in something that's going to make me a millionaire, but the process to get there, you don't really want to have to deal with. You are going to have to hit times like this to get to the place that you want to go to. It ain't fun, but that's the truth, right? When the market dips like it did in 2020, or really market crashed in 2020, and it is, halfway there, halfway crashing. So far, I think we're down close to 13%. These are the times where everybody says buy low, sell high, and when it goes low, nobody buys, everybody panics. That's not how you want to go through this. And if you're looking for what to do, this is the time where you need to sit down and do two things. Number one, you need to have an honest conversation with yourself or your financial planner, but especially for yourself, to say, are you someone, or really, does your portfolio match who you are as an investor? Because everybody says that, I want to hold for the long term. I want to get, X amount of gains or what have you. But do you really, right? Like, for example, people are asking, like, should I sell Facebook? Should I sell JP Morgan? Should I sell X, Y, and Z? Like, there are certain things that I can deal with that in the market where it drops a certain percent. I'm like, I'm fine with that. There are other things I can't. Like, I'm someone who, for PayPal and Square, back in December, and even Disney, you can throw this in there too, I said, enough is enough. This does not fit with me. I cannot do this. I'm going to sell and go somewhere else. You have to decide that for yourself. If you're somebody and you're complaining about 10% drop, a 10% loss in this year, where the market is down 12 and companies like Netflix are down 70, then you got to recalibrate, right? You got to say, hey, here's who I am. Here are the investments that are going to match with that, and I can be a better investor for that. There is no magic percentage, okay? So, like, for me, I don't have a 40% down, I got to get out. It's just I understand, how things are performing relative to the stock market. And I said, look, y'all are way down here and the stock market is not. I'm going to have to get out, right? So right now, for me, if the market is down 13%, and it's a stock that is around that space, maybe down 20, maybe down 10, I'm probably okay with that, because you're going the same way the market is. But if you're down 70, we're going to have a conversation. I need to ask more questions. I need to say, hey, what's going on here, right? So for Netflix, right? For Netflix, and we talked about this before, their entire business model is changing. They have way more competition now than they had in the last 2 or 3 years. But also, Netflix was down 54% in 2004. Netflix was down 60% in 2011. So are you someone who said that I can always buy and hold and believe in these companies? Or Are you someone that you need to make sure that those stocks match who you are and that you need to understand the business a bit better? These are questions that only you can answer. And then also on top of this, we've been talking about, and the reason why I do videos every day is that you can go back and document all the news and things that we've been talking about. We've been saying for a while that tech is not the best place to be so far in 2022. And I don't expect that to change. So what I'm not going to do is overreact to losses in the tech space. That doesn't make sense. I expect tech to be trash. I also expect not to sell Apple, Microsoft, or Google. I ain't never said that about Amazon. We're going to find out, right? But I expect that. So for me as an investor, I'm okay with what's going on. I don't like it, but I'm okay with what's going on with Netflix, with Microsoft. Okay? I don't look at it. I just keep investing because I know how strong Microsoft is. I know how strong Apple is. I know how strong, $70 billion buyback for Alphabet, aka Google, and Apple I think is doing a buyback too. So like, I am matching who I am with an investor to things that I like and things I can tolerate, but also getting rid of the things that don't fit my profile. Block did not fit for me. PayPal did not fit for me. I thought they would. They did not. So they had to go. So you need to ask and answer a lot of those questions for yourself. The market is going to be the market. I don't expect the market to recover and be positive in 2022 at this point in time. Is there still 75% of the month of the year to go? Yes. I also didn't think in 2020 that the market would recover the way that it did. But you know what I did during 2020 and even the years before? I kept investing. I kept dollar cost averaging. I kept minding my business the same way I'm going to do now, because I've already done the research for my company. I'm not going to be right 100% of the time. And when I'm not, then we make those tweaks. So right now, you need to decide and sit down and say, hey, what did I think coming into these investments? What is going on? And do these match up with who I am? And what things do I need to change, if anything at all? I think I got people on Instagram and stuff was like, hey, should I keep Meta? Should I keep this? Should I keep that? I can't answer that for you because I don't know how you feel about that company. I don't know that if X happens, like if it drops by X%, are you going to react to it? Last I checked, and I haven't read into it yet, they had a great earnings number. They might be all right. In fact, yes, they were up like, what, 12 or 13% the other day? So maybe they're fine. Maybe they are, right? So I can't tell you how to gauge. I also don't know when you got in. I got in 2012, and I'm probably gonna hold on to it, right? But that's me. You have to decide for yourself what works for you. What did you think when you got into any investment? I think that is really, really important, because when you don't document why you got something, and that's one of the good things about public, is you can go back and read your own receipts, and you can go back and read my receipts on right here on this channel about what I think about certain things. But for example, for Capital One, I said rates are going up, or I thought rather rates are going up, I'm getting Capital One. Rates are going up, but now people are thinking about recession, so it's not matching. So guess what? That's an easy stop for me to say this needs to be replaced. If you don't know why you got into something, you're not going to know and have faith and confidence and understanding whether you should get rid of it or whether you should keep it. I understand there's a real solid reason why I'm going to hold on to a Microsoft, to an Apple. If I don't, if those things don't match up, or if that case as to why I did those things no longer add up, then you have to make that switch. I think that is the answer to the question you might be looking for. So you bought Netflix 5 years ago, and they were the most dominant player in the space. They're the biggest, baddest streamer out there. They were killing the competition. They had the best content. Then you would have held on to it until those things change, and they have for Netflix. If you got into Amazon because they were everybody was at home and everybody was ordering from Amazon, and Amazon Prime was doing this, and the third, and they were making money, then you may not do that anymore, because are they, right? They're actually losing money now for the first time in a while. So all of these things play into the factor of what you're going to do, but it also plays into the calm factor that you may or may not have at this point in time. I am calm because I know I got into certain stocks, and I know when I'm gonna get out of certain stocks too. Like I've already named Capital One. That's the first one on my radar. I was like, I thought this, it didn't work. We're gonna have a talk. right? And I know where to go, and we've talked about that, and I've done an entire section on defensive stocks. So those are other areas too. It's about having a plan. It's about knowing what matches for you and knowing why you got into the investment in the first place. All right, that closes our therapy session for today. Hopefully we won't have to have no more. That'd be ideal, because the market, we do these when the market is as bad. But therapy is important. You should go even when things are great. So take that how you will. But that is it for me. I will talk to y'all probably on Monday. Sometimes I do extra sessions for those who subscribe, sometimes on the weekend. So we'll see. All right, that is it for me. I will talk to y'all later. Let me know what you think in the comments below. And make sure you're on the email list. That link pops up at the bottom. Make sure you sign up for these free classes. Those links pop up at the bottom. All right, talk to you later. Bye.